what's up guys? Welcome back to Jeff of All Trades. And today we're going to be covering options. So before we get into that, I just want to remind you guys that I'm really just doing this for fun. I'm not a professional. This is not financial advice. And I just want to share my knowledge and things that make me successful trading in the stock market. So on to options. This has been a highly requested video because options can make people a lot of money in a short amount of time.
Tell them to bring me my money.
Compared to just regularly trading stocks. But because you can make so much trading options, that means there's more risk associated with it as opposed to just trading regular stocks. So I don't really recommend this for beginner traders. However, I'm making this video because it's highly requested. So when we look at options are just pretty much the contract that gives the owner the right to buy and sell the stock at a specific price in the future. And before I get into the details, just a reminder, this is not formal. I want to keep this understandable. I just want to put everything in like layman's terms so you guys can easily understand it and digest the information. And at the end of the video, I'm actually going to be providing a in real life example of how an option would work. So there are two types of option contracts that you can get. So you can do a call option or a put option. So a call option gives you the right to buy a stock at a certain price in the future, and a put option gives you the right to sell a stock at a certain price in the future. So first we're gonna get into call options. So like I said before, like the call option gives you the right to buy a stock at a certain price in the future. So when you're buying this stock, you're getting it from a seller and the contract is created through your broker. And the broker enforces this, so it's not like you need to sign anything or anything like that. And it's the same thing for a put option. You can buy as many contracts as you like, but however, keep in mind that each contract holds 100 shares. So what you're really doing is you're securing the right to buy 100 shares of this stock at a certain price in the future. However, just keep in mind that you don't actually need to buy the stock. You can actually make money off of selling your contract, and that's why options are so popular, because people tend to buy the contract and then they'll sell the contract for more than what they bought it for. So with call options, you're expecting this price of the stock to go up because you want to buy it at a certain price in the future. So let's say like the stock right now is trading at like $15 and you think that like maybe it's going to hit $30, or maybe it's the beginning of the year, it's a small company and you see it has a lot of room to grow. So you want to secure the right today to buy the stock at like, let's say $20 in the future. Another thing to know is that when you're buying these contracts, there is a due date. It's called the expiration date. And that's the date that you have to decide whether you're going to buy or sell these stocks, or you're going to buy or you're going to sell your contract. So let's take a look at an example of a call option. So now we're going to be looking at an example of an option, so called and put options, and we're going to be using Robinhood as our trading platform. And the stock that we're going to be using today is Fuel Cell Energy. So I actually bought this call option on January 22nd when it was at $17. So keep that in mind. And when we're on the desktop, we're gonna go to the bottom right corner and click Trade Options. And this is pretty similar to the mobile app. So when you go to, when you click Trade Options, you'll see the options menu and you'll have filters above that say buy, sell, call, put. So you can just click those. And then we have the expiration date / due dates that your contract will either expire or you can exercise it out. So we're gonna actually click, well, we'll just leave it here for now. So one thing I hadn't mentioned yet is, so here's the current stock price. So Fuel Cell is at $22 and here's the current stock price. Anything below this price is considered in the money. And what that means is, well, you're buying the right to purchase it at a price lower than what everybody else is buying it. So you're already guaranteed profit. And anything above that is considered out of the money, and you're hoping that the stock price increases so you can make some money. And the reason you'd purchase an out of the money contract is because it'd have like a lower premium and you actually believe that the stock price is gonna rise. So you're taking a risk here, and the premiums are lower for out of the money and higher for in the money because, like I said, in the money is less of a risk because they're already below the stock price. Now we're gonna look at break even. And this comes into play when you actually plan on exercising the contract. So the break-even price consists of the strike price that you're going to purchase the stock at in the future and what you paid for the contract. So when you add these two together, you'll get your break-even price, and you multiply that by 100, and that's what you'll be paying in total in that future date. So really, you'd want the price to go above your break-even in order to make profit if you plan on exercising. Remember that when you buy these contracts, you have the right to purchase the stock at this $21. However, you do not have the obligation. So you don't have to purchase the stocks. You can actually just buy and sell your contract if you'd like. So now we're gonna go ahead and change the expiration date, and we're gonna go to January 21st, 2022, so you guys can actually see the contract that I purchased. So I purchased a deep in the money call option, and this is considered a long call because it's a year out into the future. And so I went the safe route. I bought a $7 call, and this option actually cost me $11.60. And as you can see, we're at $16.10 now. So this means that my contract increased in value. And this is an important thing to note because all you need is the share price to actually go in an upward direction in order for you to make money if you just plan on selling your contract. So I bought this contract at $11.60 and it's gone up already. And this is after a week. Now that was a call option. So now we're gonna talk about put option. So a put option gives you the right to sell a stock at a certain price in the future, right? So when you're thinking about getting a put option, you're thinking that the stock is gonna go down. So you're betting against the company and you think that they're gonna not perform too well and the stock is gonna drop in price. Put options are a lot more risky than call options because with put options, you can have unlimited losses. So when you actually purchase a contract for a put option, you have to, if you don't have the 100 shares in your portfolio, you have to borrow them from your broker. So you're gonna have to buy 100 shares of that stock from your broker and you're gonna have to sell them today. So the idea is that when you buy them back later at that lower price because you're betting against the company, that you're gonna buy those 100 shares back at a lower price, which means you're gonna get a gain, right? Because you borrowed it, sold it for a high price, and then you have to buy them back at a low price. So you're making profit. The reason people say that like put options have unlimited losses is because think about this. So say like you borrow 100 shares from your broker and you sell them at this high price today. Well, if you were wrong and the stock actually doesn't fall and the stock starts to go up, well, your broker can issue a margin call, and that's when they're just like, well, look, we don't see this looking too good and we're gonna make you actually buy back now. You're gonna have to buy back these shares at this current price and you're gonna have to come up with that money. And if they don't do a margin call, well, what can happen is the stock price is going to continue to go up and you're eventually going to have to buy those stocks back. Stock prices can go to infinity essentially. And if you don't have the funds or a good exit strategy, you could easily put yourself in debt in a really bad position. So now we're going to take a quick look at what a put option looks like. And now we're going to look at some fuel cell energy put options. So we're going to set it to buy, put, and then we're going to start with the February 19th date. So unlike call options, anything above the share price is considered in the money because you want to sell at a higher price than what you have to buy it back at. So for instance, you're buying the right to sell at $24 when the stock is at $22. So that means you're going to net a gain. And anything below the share price is considered out of the money because you're taking a risk and hoping that it goes below the strike price. But currently the share price is above that. Keep in mind that you're buying the right to sell, you don't have the obligation to sell. So the most amount of money that you can lose is the premium that you paid for the contract. And this is only if you do not decide to exercise the stock. If you decide to exercise the stock, you can lose a lot more money. And okay, so this is where I need you guys to really pay attention because if you don't know what you're doing, you could lose all your money and put yourself in a really bad position. So if you decide to exercise these shares and you don't have the money in your account, well, you have to borrow the money. Well, you have to borrow the stocks. So you have to borrow the shares from your broker, and you'll have to borrow 100 shares from your broker, and they'll be sold immediately. So you'll get credited the money. So let's say it's at $22. You'll get credited $2,200 to your account. However, if you're wrong and the share price does not go down and it actually goes up, well, this is where unlimited losses come into play because fuel cell could go to $1,000. And you'll have to buy those 100 shares back at $1,000 a piece. It's not enough to just pay the $2,200 back. No, you have to pay back the 100 shares. So you'll end up having to come up with $100,000 to buy fuel cell in order to pay back the 100 shares that you borrowed at $2,200. So if you do the math, you're in the hole like $98,000. So please do your due diligence, research, consult a financial advisor before you buy any put options, exercise any put contracts, or just honestly any options in general if you don't know what you're doing. So now that we've seen an example of a call option and a put option on Robinhood, we're gonna take a look at what a call option and put option would look like in real life. So say your friend is the plug and he was able to get a couple PlayStations, and let's say you couldn't get one because you don't have the money right now. So you go to your friend, you ask him, hey, I'll give you $50 if you can hold this PlayStation for me for 6 months and sell it to me at $500, because that's what the PlayStation is going for right now on the market, $500. And you think that, PlayStation is gonna get more popular and the resale value is gonna be super high. So you're banking on trying to get the PlayStation at this lower price in the future. The $50 represents the premium, so that represents what you pay for the contract. The agreement between you and your friend represents the contract. The PlayStation represents the stock, and the 6 months represents the expiration date / due date. So 6 months from now, you're right. The PlayStation has gone up in value because it got super popular and they're going for $700 on the market. Luckily, you paid your friend $50. He's holding this PlayStation for you. So now you get to buy the PlayStation for $500. And now you can sell the PlayStation for $700, making $150 in profit because you paid $50 to your friend to hold the PlayStation, $500 to actually buy the PlayStation. So that puts you at $550. You sell the PlayStation for $700, and that makes you a profit of $150. So now that was an example of a profitable call option in real life. So now we're gonna look at a not so profitable call option. So say you were wrong and actually PlayStations decreased in value because they've become so widely available and now they're on a discount. So you can get a PlayStation at Walmart for $300. So it wouldn't make sense for you to go buy this PlayStation from your friend for $500. So what you're gonna do is you're gonna let that contract expire, and now your friend just got that $50 for holding it for you. That was what y'all agreed on. So you're letting that $50 go, and now if you really want to, you can go buy a PlayStation at Walmart for $300. So that's an example of a call option in real life. Now we're gonna look at the put option side. So same scenario, your friend is a plug, he got a couple PlayStations and you don't have any. However, this time you think that the PlayStation is gonna drop in value. So what you do is you reach out to your friend, you're like, hey, can I get this PlayStation from you? Because remember, with put options, you have to borrow the stock up front. So in this case, it's gonna be a PlayStation. You have to borrow this PlayStation up front. You're gonna ask them, hey, can I get this PlayStation off of you? And what you wanna do is you're gonna sell it today. So you reach out to your friend and you say, yo, I'll give you $50 if you let me borrow this PlayStation for 6 months and I'll give you a brand new PlayStation back. And he's like, okay, that's cool. So he gives you this PlayStation today and you sell it on the market. Market value of the PlayStation is $500. So you sell this PlayStation today for $500. You gave your friend $50 in order for him to let you borrow it. So 6 months from now, you have to give your friend a brand new PlayStation back. However, you're banking on the PlayStation decreasing in value so that way you can buy it back at a cheaper price. So 6 months from now, it's coming time for you to get this brand new PlayStation back for your friend. So you originally thought the price and the value of the PlayStation was gonna go down. However, you were wrong. The PlayStation actually increased in value, and the only way to get it is to get it from a greedy reseller who's charging you $700. So now you have to buy the PlayStation back for $700, which puts you at a $150 loss.
What? Bro, what are you talking about, man? Bro, I'm out, man.
Which puts you at a $250 loss because you have to pay your friend $50 to borrow his PlayStation, and you just paid this reseller $700. So that means you have a cost of $750, and you sold the PlayStation originally for $500. So that nets you a loss of $250. So remember what I said before, put options are a lot more risky because the resale value could have went way above $700. And I mean, in this example, you made an agreement with your friend and he might be a little lenient, but in the stock market, you're not gonna be borrowing from your friends. So you wanna make sure you do your due diligence and do your research before you get in any put options or any options in general, even call options, because you can still lose money. You can lose your premium, and you wanna limit your losses as much as possible. So make sure you do your research and due diligence. So that was an example of a bad put option. Now we're gonna look at an example of a profitable put option. So it's coming to 6 months and you gotta buy this brand new PlayStation back for your friend, and you're right, the PlayStation actually decreased in value. Now they're on sale at Walmart, and now you can buy it for $300 on sale at Walmart. So you sold it for $500, and now you get to buy it back at $300, and you paid your friend $50 to borrow his PlayStation. So that puts you at a $150 gain because your total cost is $300 that you bought it for, $50 for the premium, so that's $350, and then you take the $500 you sold it for, net those two, and that puts you at a $150 gain. Lastly, keep in mind that these are single PlayStations, so single stocks. However, in the market, you're gonna have to take these and you're gonna have to multiply it by 100 because each contract has 100 shares in them. So these may seem like little losses because you're just doing one PlayStation, but if you're in the market, you have a potential to lose a lot more money, but also gain a lot more money. And on another note, I wanted to cover risk management real quick. So what I personally do is I usually put 5% of my portfolio into option plays. And that means that every time I buy an option, I might use 5% of my portfolio, 5 or less. That's just my personal preference, nothing that you have to actually stick by. Hopefully you found this video helpful. And if you did, please leave a like and subscribe to my channel and turn on the notification bell so you can get notified every time I post. Best of luck trading and stay safe.